If you wanted to buy the entire company with no cash and no debt on, you'd pay $2.14 trillion. Sounds expensive. Can Microsoft do that? Sure. That's my take on it. Microsoft is getting a lot of attention. It is a great company, great cash flow, great balance sheet, all around wonderful, wonderful company that you should focus on. But remember, if you are an investor, which is synonymous with value investor, you don't pay whatever price just because you love a company, right? Ferrari makes a phenomenal car, but it doesn't mean that you pay whatever price that Ferrari asks for that car. There's still a limit as to what it's worth. Same with investing. If you can get your mindset into the fact that when you buy a stock, you're buying a piece of a business, you are going to do very, very well in investing. And it takes a certain amount of time to get yourself into that. I still work on it myself every single day. It is not easy. I'm not to the point where I want to be yet in that regard. However, I'm much further along than most. So let's go check out Microsoft. You know, I looked at it the other day. Microsoft's almost 50 years old. 1975, that company started. I was just looking at it the other day about like oldest companies, and I was looking going, oh my God, Microsoft's 48 years old now. 48 years old. All right, so here's Microsoft. Let's take a look at our software and some of the high-level aspects of Microsoft. It's down a little bit today, 275. All-time high, November 22nd, 2021, at $349.67. All right, now it's at 275, had a recent low on November 4th, 2022. By the way, I see this date a lot in a lot of the lows. I'm seeing this date a lot. Facebook, Google, I think, had very close to this, 213.43. So it's up 30% almost from its 52-week low. All right, so first things first. Market cap, $2 trillion. Enterprise value, $2.14 trillion. The difference here is essentially cash and debt put together, netted out. If you wanted to buy the entire company with no cash and no debt on, you'd pay $2.14 trillion. If you want to buy all the shares outstanding, you'd pay $2.06 trillion. Now, 1-year PE, 30. 5-year PE, 38. Sounds expensive. Is it expensive? Well, that's the main question. Remember, when you have companies with growth potential or a high return on invested capital, which Microsoft has at 24.4% over the last 5 years, you can absolutely justify a higher price. How much higher? That's the art of investing. That is what makes investing difficult. If Microsoft had a lot of things to invest in and they could keep deploying this $60 billion that they make in the last 12 months and it keeps repeating over and over and reinvest it every single year back in the company, they would increase their profit every year by 24% times 60 billion. How much is that? So $15 billion a year. That is the theory behind the return on invested capital. Great. $60 billion, reinvest it, 25%. Now the next year you're making $75 billion. Reinvest that. What's 25% of that? It's another 1/4, 18.5, 19 billion. So you're at $94 billion. Reinvest that. You're at 20. You're now at $114 billion, and it keeps growing. The question is, can Microsoft do that? Well, not necessarily, but that's okay because eventually they'll find something to invest in and it won't take as much money to invest in that to get a high rate of return on your money. And they can take that extra cash flow that they didn't spend on those areas and return it to investors through share buybacks when the stock is low, paying out dividends and paying down debt. Okay, so this software helps you with that. Guys, we're running a special right now, $7, 7 days. Check it out, everythingmoney.com. It'll change the way you look at money. You have the community here. You have all of these tools that drop down and more that are coming. As we add more tools, your price level stays the same. All right, 5-year profit margin, 33.7%. 1 year, 33. Okay, so it's pretty consistent. And with a gross margin of 68%. That means every extra dollar they bring in, they can keep their overhead the same, and 68 cents of that dollar goes to the bottom line to pay taxes. That is incredible. That is a lot. All right, dividend yield, about 1%, pays out $19 billion. And they can easily afford that. Their 5-year average free cash flow is about $50 billion. So they're only eating up about 40% of their free cash flow to pay out in dividends. They can easily afford that. All right, that's pretty good. Next, let's go look at the 8 pillars for Microsoft. Now, guys, remember, if you have our software, you can edit your 8 pillars, make it up to 12 pillars. There are 4 trillion or so maybe it's quadrillion. I don't even remember the number is, but those are the number of options you have in combinations for the pillars. But I stick with my original pillars, and I do change them. They're not the original ones. 5-year PE is an X at 38. 5-year price to free cash flow is an X at 42. Feels expensive. Feels really expensive. But again, we don't know. What's the growth potential for Microsoft? Let's go check out what analysts are saying. Now remember, guys, analysts have their biases. They're expecting Microsoft to make about $10 a share this year, $9.55, growing to $16.30 in the next 4 years. But keep in mind, number of analysts here are 51. Number of analysts in 2027 is only 4. They have bias. Remember, I will be using this example till I'm blue in the face. Silicon Valley Bank, the day it went under, the day before, whatever, the week before it went under, they had 0 sell ratings by analysts. How can banking analysts, the one banking analyst I knew, he avoided Silicon Valley. His comment was, listen, I didn't know there was going to be a run of the bank. I didn't know exactly how bad it was. However, there were other indicators that said, stay away. And that indicator was they don't swap out their risk on their interest rates. And that to him was banking 101. He's like, they're not doing it. I'm avoiding it. He was not trying to claim that he saw this happening. He did not say, you cannot see a run of the bank happening the way it did with Silicon Valley Bank. That was literally run that way. But the point is, be very careful about analyst estimates. But we bring it in here because our users want the analyst estimates as a guide. And if you see right here, there's some big growth rates for that EPS. And that's why the high return on invested capital is so useful. Let's see where the revenue growth is coming. $213 billion this year and $348 in the next 4 years. That's big growth, guys. Big growth. For a large company like this, it's a lot of growth. But again, as the world becomes more and more developed, Microsoft will get a bigger piece of that pie. All right. By the way, not even a bigger piece of the pie. If they get a smaller piece of the pie, but the pie is much bigger, that's going to go very well for Microsoft. They have the Microsoft tools for Microsoft Office are so incredibly valuable to everyone who uses them. We as a company use OneDrive. It's essentially the Google Drive, but for Microsoft, and I love it so much more than Google Drive. So much more. I actually get to use Microsoft products. So that's my take on it. Now, what do we pay for Microsoft? Now, remember, I lately have been looking at companies that I want to own for 20 years. I've changed my methodology of buying stocks a lot in the last 2 years because I realized how much more effort it takes. Now, the difference is I've now accepted the fact that my returns might not be astronomically huge. Like I know people who beat the market 6 to 10% a year over 15, 20 years. I ain't going to do that. That ain't going to happen for me. Why? Because I want big companies like Microsoft. They're a lot more efficiently priced. It will take quite the catastrophic event for Microsoft to sell at absurdly like 15% returns. Could it happen? Absolutely. Is it likely to happen? Probably not. But I'm okay with that. I'm okay buying Microsoft at a good price where I can make 11, 12, 13% of my money because of mispricings in the market. Plus sell some covered calls along the way and do well that way. But remember, it's harder with larger companies to find the real compounders. What you're hoping for is you're hoping a company like Microsoft sells cheap enough where they can justify buying back their shares super cheap, use their return on invested capital to keep their profit stable, have that high moat, and you'll probably do pretty decent over the long haul. But you have to pay the right price. And that's what our stock analyzer tool helps you do. Won't do it for you, but this was used 1.3 million times last year by our users. And since I like Microsoft for the long haul, I'm going to do a 20-year analysis. And guys, if you look at past videos of Microsoft that we've made, we're not going to do the same analysis now we did back then. We might have done 10 years before. I might have made assumptions, but overall, you're going to get a feel for, is Microsoft overpriced, underpriced, selling about right, etc. So let me do a quick pause. Let me put my inputs in here real quick, and then we'll come back and discuss what I've come up with. All right, so I looked back at my history because we can look at our history of stocks we valued. And I looked back and it's been a long time since I did Microsoft a 20-year analysis. So here's what I did. For revenue growth, I did 4% a year, 7% a year, and 10% a year. 4, I think, is pretty low. But again, I want to be low, middle, and high. Middle is probably where I think it's going to end up being. 7% growth a year. That's doubling twice over the next 20 years. All right? So it's going to take their revenue to $1 trillion or more. That's pretty substantial. Profit margin. Now, here's what I did on profit margin. Their 10-year profit margin is 28.6, but it's clearly gotten better. They have a high gross margin, and they're getting more and more into subscriptions and cloud-based computing. So I started at 28%, went to 32, which actually might be a little on the low side, but I went higher to 36% on the high side. Even though they don't have a track record of 36%, I still wanted to go high going, listen, this gross margin's pretty good. It's going to keep adding to the bottom line. And my guess is they can grow their revenue and profit faster than they need to grow their overhead and their costs to operate. So that's a big reason why I did that. Free cash flow margin, I went a little bit lower on free cash flow, 28, 30, and 32. I just noticed there was a little discrepancy here on free cash flow. Just slight. So I was like, okay, let me just be a little conservative. Now PE. Current PE is 30. Current price of free cash flow is 34. Don't be that person that compares it to the current numbers. Don't. Historical average for the stock market's 15. And I'm okay doing 15 on my low side for both PE and price of free cash flow. It's a high moat business, high return on invested capital. So I went higher, 16.5, 18 on the middle and high. Now, for our desired return, I actually did 10, 12, and 14. I do think these levels right here, 10% growth per year in revenue, guys, that's a big number. That's doubling every 7 years. So in a 20-year period, they're doubling 3 times, which is 8x. Is it possible? Sure. Is it probable? I don't think so. And that's why I want my higher return, 14% a year. Because I'm like, you know what? It's less likely to occur. So I'm going to hit the analyze button. 6 numbers are going to pop up. If it's all red, just add it to your watch list at the price you want it to, and it'll notify you in the software when the stock has hit that price. It'll notify you on your app, on email, and in the software. 2, if it's all green, do more research. Make sure you feel comfortable. It'll be worth it for you to sign up. Try to talk to people about Microsoft in the chat. It might be a good area to be at, because I look at Microsoft going, this company's going to be around for a very long time. They got a great balance sheet. This is the kind of company you want. And you might sit there and say, Paul, I'm okay making less than 10% on Microsoft at these low numbers. I fully agree with you on that one. Part of me goes like, hey, I'm being pretty conservative here. Is it okay if I put 8% in here? Maybe. I would not argue with you on that one. I would not argue with it. That's the art of investing. It's all about how you perceive the value of a company. So hit the analyze button. Boom. Low price, 125. High price, 200 to 225, middle price, 160 to 170. I have my watch list at 190, which means when it hits 190, it's going to notify me and I'm going to start selling puts at lower prices. Guys, everythingmoney.com, $7, 7 days. Check it out. Thank you.